Hi everyone, welcome back to my channel. My name is Sandy Somdwini, and today I actually want to discuss sex and marriage. I mean, this is a month of love, people are getting married, so it's love, love, love all over the place. So that is why today I decided, let me talk about sex and marriage, because there's some things that you need to know before you get married, or if you are married, there are things that you need to know pertaining to marriage intakes. Now, before you say I do, you need to understand that the type of marriage regime that you choose actually has some kind of effect in the type of in the way that in the way that SARS will tax you and your partner. So it is very important that before you actually go into marriage, you consider all those things and make sure that you understand what will happen to you and your husband's taxes after you get married. Now, there are different types of marriage regime. There's in community property, there's out of community property with accrual, there's out of community property without accrual. In community property, obviously, is the one that says eyame yakho, which means whatever you have and whatever I have is half yours. Whether it's debts, whether it's assets, everything basically, you share everything equally with your spouse. And then there's marriage in out of community property without accrual. Now, this one says that whatever I have before we get married remains mine. And then whatever we build together, then we will share according to the antenuptial contract that we draft. So in most cases, it is equal. That is now marriage of community of property, out of community of property, with accrual. Now, marriage out of community of property without accrual means that what's yours is yours, what's mine is mine. We don't share anything. Even after we get married, whatever you make, whatever that I make will remain yours, and whatever that you make, I make will remain mine. Those are the three marriage regimes here in South Africa. Now, what I'm going to be talking about today mostly is the marriage of in community of property, because that's where you really get affected by tax if you are married in community of property. So this is why it's very important to actually do your research, know what you're getting to before you get married. When you are married in community of property, that means that now all your assets and liabilities will be in your joint estate. And if your spouse or you get any other income other than the normal 9 to 5, that income will be taxed. Half of it will be taxed on your tax return, and half of it will be taxed on your spouse's income tax return. In other words, for those people who are married in community of property, I don't know if you have noticed, but when you're actually completing your income tax returns, there's a question that asks that, are you married in community of property? If it's yes, then it's going to ask your spouse's details. The reason for that is, if, for instance, you have, say, for instance, rental income. That rental income, when you're completing your income tax return, you need to show all of it, the income and the expenses, and then the profit. What SARS will do is will take 50% of that and tax it in your income. And then they will do the same with your spouse. They'll take 50% of that rental and tax it in your spouse's income. It doesn't matter whose name the house is in and whatnot. If you're married in community of property, any investment income is taxed that way. That is why it's very important to know this before you get married. Because say, for instance, that your spouse has a lot of investment income. That means that now half of that investment income, according to tax laws here in South Africa, it's going to become yours. That means that, say, for instance, you're in the 18% tax bracket, that would actually take you in a bigger tax bracket, which means that you could now be taxed higher, because now you're getting all this, you're getting 50% of all that income. Now, what you need to remember when you are completing your income tax returns, you should not split the income yourself. Say, for instance, the rental income is 100,000 rand, the expenses are 15,000 rand, which means that the profit is 85,000 rand. You do not split that income. You show all of it in your income tax return. SARS will then, because you've ticked that you are married in community of property and you have put in your spouse's details, SARS will do the splitting themselves. This is where most people make the mistake. And this is where they get in trouble with SARS. What they will do is they will split the income themselves because they're thinking 50-50. No, SARS does the splitting on the return on their own. All you need to do is to make sure that after you've submitted your return and you look at your assessment, just make sure that SARS has actually done the splitting, because it has happened in the past that the system malfunctions or something happens and you find that SARS has put all that income in your tax return, or for some other reason you just omitted to click that you've married in community of property, and then SARS includes all of that income in your income tax return, and you end up having to pay a much bigger income. So in other words, if I can conclude, when you're married in community of property, it means that you're sort of in a partnership when it comes to investment income. Remember, investor income is all the income that you receive, your dividends, your rental property, your interest, and all those incomes that you receive that have nothing to do with your job. Because remember, when it comes to your job, your salaries, if you have a 9 to 5 and your spouse has a 9 to 5, that income is not split. That income is not split. You are taxed, or the one spouse is taxed on that income on their own. None of that is split. And the other spouse as well is taxed on that income on their own. The only income that is split is the investment income. I just gave an example of those. That will be your rental incomes, your interest incomes, your dividends, and all those things. Those are the incomes that are split. One more thing, it is very important that your spouse, if they're receiving all these incomes, that they declare to you, so that you also are able to declare that into your income tax return. Because if they don't declare, then that means that you will not be showing that into your income tax returns, and you might be in trouble with SARS. So that's also very important. Now, you who are married out of community of property, this does not affect you at all. SARS taxes you per normal as if you were single. So it doesn't affect you at all. It doesn't do anything for you. If you're married out of community of property, then your investment income is taxed on you if it's in your name. Your spouse's investment income is taxed on your spouse's name. Everything, it's just as per normal, as though you are still not married. So the only people that get affected by this is those people that get married in community of property, right? And those people, for instance, that say for instance you get married and you do it the traditional way, then in that way that means it might happen that you did not do an antenatal contract. Then SARS takes it, SARS and Home Office takes it, you married in community of property. In fact, in any case, the law says that if you don't draft an antenatal contract, then Home Affairs, SARS, everyone, all these departments, they take it that you married in community of property automatically. So if you have no intentions of getting married in community of property, even though at a later stage you can still change, then I would advise that you do it from the beginning. It's not expensive to draft an antenatal contract. In fact, if you have, or if your spouse has paid lobola, or you've had a wedding and all of those things, then it shouldn't be expensive to draft an antenatal contract. In fact, I would even say go as far as that instead of spending money on a lavish wedding and whatnot, just make sure first that you have an antenatal contract if your intention is to actually get married out of community of property. Even though at some point, at some stage after you've gotten married, you can still do a postnatal contract, but I mean it gets complicated after you've acquired debt and assets and whatnot and all those things. So that's very important. Now, just to tell you one of the advantages of actually getting married. One of the advantages of getting married is that you don't pay donations tax if you donate to your spouse. That's the nice thing about it. Donations in between spouses doesn't trigger any donations tax. So that's one of the advantages of getting married. If I've been dishing out all the bad news, if I should say, but now that's one of the advantages. So it would be nice to actually I'm sure it's nice to know that if you've actually acquired some wealth and you'd actually like to decrease your estate, one of the things that you can do is to donate some of that wealth to the spouse that hasn't acquired more wealth, in order to make sure that you pay as little estate duty as possible. I know this is out of topic, but I mean, we're talking about marriage, so I thought I may as well. Now, if you are happy with this with this information, please comment down below. Let me know, are you married? Are you about to get married? Have you done an antenatal contract? Did you do a postnatal contract? I'd really love to know. And also, please do subscribe to my channel, and also give me a thumbs up if you found this video useful. Thank you so much. See you on my next video.